Conley usually logs in with 2 accounts. I don't know where his other account is.
Well, the one that he's got his webcam on, he had to log because he said he wasn't picking up the right mic, so he'll be back in a second.
Okay. But Carmen's playing Zelda Breath of the Wild. Pretty good.
Switch?
No. Wii U, man. Old school.
Okay.
The same one as the wedding.
The one on the Switch is supposed to be good, supposedly.
I mean, I figure it's the same game, just different controller. But the Wii U is nice because we can play in our bedroom when Frankie sleeps outside because it has a little screen. Oh, I guess the Switch would have that too, but yeah. You can see the evolution of Nintendo going from like, to smaller mobile and then like hybrid. So it's kind of cool.
Do you expect is Conway there?
It's lagging like crazy, but I can hear you guys.
Hear you.
This is my old laptop. It's the only working webcam that I have.
Wait, what about your normal setup?
This is my normal setup.
Yeah, usually it's fine.
Right. And it's lagging like crazy today for some reason. I don't know why.
You expect
We had that happen before. You just needed to restart your router or something.
I need to restart this laptop, but
let me turn off some stuff on my side.
I don't think it's you. This is just my laptop.
I was running this crazy farming server, so hold on.
You were what?
I'll get into it. Just wait for it. I've been researching all this crypto stuff for Conway.
For me?
For you.
What does that have to do with farming?
Well, farming's the new mining. Anyway, let's see. I think I turned it off, so should be good. At least on my side. I can rejoin real quick.
You expect Oleg to be on too?
Oh, let's let work so he won't make it. Or he won't make it till later.
I'm going to tap the microphone, so if you hear loud sounds. Oh, okay. It's working.
Yep.
Well, my Discord client is just showing a blank white screen, so I'll turn on the camera when I can.
Okay. I turned off my camera in case you guys are lagging.
Nah, it's my computer. It's not an internet issue. It's a hardware issue.
Okay, anyway, guest star today.
Yeah. Mike, how you been? Thanks for joining us.
Doing okay. I was talking to John earlier, and he said that you guys had a podcast coming up, so
yeah,
invited me to come on, so I'm here.
Cool, man. How you enjoying Clubhouse so far?
It's okay. I joined a lot of aviation clubs and a lot of rooms where got pilots talking and stuff like that. So it's pretty interesting to hear some of them. What I found on Clubhouse though is that sometimes you just have people that do nothing but talk about what they've done in their lives, and that's not relevant to me at all. I don't care.
Yeah.
Every so often you'll find a moderator that's good that doesn't just let somebody talk for 5 minutes, and also you find some people that are pretty interesting.
You might have used it the most compared to all of us.
Me?
No, Mike.
I'm actually on there all the time now, but it's mostly just with a group of friends, I guess. It's my cousin's husband that started it, and we met a bunch of people on there. It's mostly to do with stocks, but at this point it's just to hang out and shit talk.
Yeah, so if you see me on it, I'm probably in some room on something related to aviation aerospace.
So that you can go on during work hours?
Sometimes it is during work hours, but other times it's after work. But I mean, if I'm not in a conference call at work, then, and if there's a room that started with aviation, I'll just try to join it just so I can listen to people. And if they ask me anything, then I'll answer if I can.
It's pretty cool. You're an influencer now.
Yeah, I mean, with like 50 followers.
It's a start, man.
Got to start somewhere.
Yeah, and you have like unique insights into the industry that most people don't have. So
Yeah, it's interesting to hear about the airlines, which a lot of pilots talk about that. More pilots that are not affiliated with airlines, it's interesting to hear how their industry is doing. So I don't really get too many questions related to engines. It's typically just about the outlook for the industry, and I can answer based on the types of models that I see. But that's pretty much it. I've only had one engine-related question. That was from a pilot.
And you have to not disclose any secrets.
Yeah. In fact, I don't even disclose which company I work for. Some people have guessed based on what I said, but I don't confirm or deny.
yeah,
Interesting.
any reason why? Is it just to maintain anonymity?
Actually, I have my LinkedIn profile on my Clubhouse profile. So if anybody really wanted to know, they could just look me up. Which I know, some people might because they want to ask me other stuff, but
Yeah,
typically people aren't going to do that, right? They don't just look up your profile.
people love
But the reason I don't is because I don't want people to attribute what I say to like as an official thing for my company.
I haven't really checked out your profile. Have you put one of those disclaimers in there that people always like to put? Opinions are my own.
I don't put that because because there's nothing to tie me back to a company I've worked for. Then that's the other way to do it. I mean, if I said that this is the company I work for, and then I would definitely put like,
Gotcha.
my opinions are my own, and I don't speak on behalf of the company.
Yeah, that sounds fair.
Well, I'm not here to monopolize the time. What just wanted to listen to what you guys would typically talk about.
Probably just me ranting. Lately, I've been obsessed with the GameStop situation and the stock market. John, he humors me by listening. But overall, he advises that I be more reasonable about things. So, pretty typical, I would say. Have you kept up with anything involving the GameStop situation or just stock market in general?
That's a question for John.
No, either of you. But I guess more towards you, Mike, since John's very used to me talking about this for weeks on end.
It's been a month. Yeah, I haven't followed anything. But Mike, maybe you have.
Yeah, so John and I were talking a little bit earlier. What we were saying was that for work, what I've been getting more into is modeling.
Modeling?
And, yeah, modeling work. Not just like cost modeling at our suppliers and that sort of thing, but modeling of the market, because a lot of the cost of the stuff that we buy, because we're so early on in the supply chain, is elemental related. So essentially the material the virgin raw material that goes into the parts, a lot of the cost of the part is that. If I was selling an engine, like an entire engine, way down the line, then obviously a lot of the cost would be the labor. But for us, it's a lot of the cost is elementals. And because of that, it's very important that we can understand how the certain trends in the market for the elementals, because we eventually get charged back for that, right? So if the elementals go all over the place, like the beginning of the year is really high and it goes down low and then it goes high, we don't really have good visibility of how much our parts will cost from a quarterly basis.
True.
So
yeah, I've been hearing rumblings about the commodities market.
Yeah, so for what's pertinent to what I do then is I would look at, I try to forecast the commodities, and to do that, you can do it the traditional way, fundamental analysis and that sort of thing. But right now, I'm looking at modeling of technical indicators.
Mm-hmm.
So I'm learning on equities and trying to apply the learnings to commodities, which obviously I'm not there yet all the way, but
it's difficult. Yeah.
Right.
He's got his own hedge fund.
Yeah. So essentially, it's like, there's this. Are we getting to the level of what hedge funds do? Obviously, hedge funds have a lot more access to data than I do, and they have much more complicated model. I don't need it to be perfect. I just need it to be good enough such that we can use it to reduce risk for us.
Right. Yeah, the stuff that I've been seeing is macro analysts saying that we're going to enter a pretty big commodities bull market soon. We're probably due for another push in tech, but some weird stuff has been happening in the markets lately. A lot of people attribute it to the bond market, the yields rising, the 10-year rising, and then that causing a sell-off in tech. But I have my own theories about it that lean towards the conspiracy theory side of things. So
you want to talk about that a little bit? Like, what do you mean?
I think it, at least right now, comes back to these super heavily shorted stocks. Mainly it's GameStop right now. And I think that is distorting the market. And I have a lot of bits and pieces of evidence. Nothing really is like a smoking gun because a lot of this information is like really well hidden, closely guarded, or just the information gets published so infrequently that by the time you actually get the information, it's already out of date. But one thing that came up recently, this is probably not the best place to start talking about this, but like I'm on a Bloomberg terminal, which is a $29,000 a year piece of software that professional Wall Street employees use to look and analyze stocks. GameStop has a beta value of -8. Now, a beta value, John, correct me if I'm wrong. I'm learning too much and I can't keep it all in my head. But a beta value basically tells you the relationship of a stock to the rest of the market. So if it's +1, it basically moves in the same direction as the broader market. If it's -1, it moves inversely. And you're familiar with ETFs. You're probably also familiar with leveraged ETFs and bearish leveraged ETFs. So for example, QQQ tracks the top 100 companies in the S&P 500. SQQQ tracks them as well in the opposite direction. It shorts the QQQ and it's leveraged 3 times. The beta value on SQQQ is -2. Meaning, if QQQ goes up 1 unit, SQQQ goes down 3 units, and vice versa. And that's a -2. GameStop is a -8 with a raw score of -13, with spikes far exceeding those numbers.
So
Now,
it's
why?
moving beta of negative, just to make sure we got scared. It moves opposite the market, correct?
Oh, yes. It moves in the opposite direction. Yeah, some
Yes.
other statistical analyses say that there is a 88.3% correlation with a p-value of like 0.001, or maybe more than that, or less than that, I should say. So they're very confident that these two things are related. So then the question is, well, why is that? And what it seems like from my research is that it's extremely heavily shorted to the point where retail investors own all of the float, and it has to do with short selling, which I've discovered is a Ponzi scheme. And John will probably be shaking his head and disagreeing with me right now. And the common mantra on Wall Street is that short selling is a healthy part of a market. And I think that it can be a healthy part of a market in limited quantities. But with GameStop, they've gone way too far short.
Right now, it's less than 25% short, right?
That's the official number that is self-reported to FINRA. And FINRA, they don't really look too closely, but the numbers that they use also don't match the publicly available information that's out there. So what you can track is ETFs, how far they're shorted, but also the failure to deliver numbers, which for some reason hasn't come out since February.
So you're saying that shorting is a Ponzi scheme. Why would you say that? Not saying I agree or disagree with you. I just want to know what you're doing.
So for anybody that might listen to this in the future, I'll start with a very basic explanation. So Mike, you have something, I'm going to borrow it from you. I'll sell it to John. That's shorting. Now you want it back, and John's not selling it to me. So where do I go to return it to you? Well, I have to go out into the open market and hope I can find a seller and pay whatever he's asking in order to return it to you, Mike, right? What else I can do is I can take what I sold to John, short that, and give that to you. You think that you have your share back, but really what I've done is made 2 counterfeit copies on top of the original copy. So you were the shareholder A, I shorted your share, and I created synthetic long B, which is what John owns. But because I could not obtain a real share to return to you, I now create synthetic long C, return it to you, A. So now there's A, B, and C. Now, there's a time window that, because of settlement dates and because of the way things work, I can just keep juggling this and never actually pay you back your real share. And I have a practically infinite ability to do this.
So for me, it doesn't matter which share that I have as long as I own a share, right?
At some point, those shares do need to be returned. But the way it is now, if I have enough liquidity and I can keep juggling it without failing, I can keep this going. But what it does effectively is, like, when you short something, it drives the price down, right? Because you're selling, and selling just has naturally downward pressure. But on top of that, because I'm creating counterfeit shares, I'm kicking that supply curve out to the right. And on a graph of supply and demand, you see that when the supply moves out to the right, price falls. Now with GameStop, what also happened was Robinhood and numerous other brokers completely turned off the ability to buy more shares at the end of January. So you cut off demand. So then that drives the price down even more. On top of that, between the start of January and today, the Wall Street Bets subreddit grew by over 7 million people. Now, maybe those are all legitimate Redditors that are just curious and saw things on the news and wanted to keep track of it. But what we've seen actually is that a lot of them appear to be bots. A lot of them appear to be shills, probably hired by Wall Street. We have some evidence that people have reached out to individuals and offered payment for writing negative comments and posts about GameStop. And a lot of the accounts, they appear to have been long inactive. And when they were active in completely unrelated subreddits and communities. Hey, Frankie. And suddenly they become active again. And they only post in stock-related channels, especially Wall Street Bets, and they're almost all negative towards GameStop and AMC, but mostly GameStop. On top of that, a lot of posts get written that are negative towards GameStop, and they seem to instantly get thousands of upvotes and tons of awards. And it's suspicious. There's a lot of suspicious activity. But also,
So
they're like,
is,
oh, what's up?
so because I don't know how the legal
Right.
system works in this case, because it could be very well considered manipulation or not, or it could just be considered free speech, right?
So the penalty for manipulation is, I think, $20 million if you're found guilty of manipulation.
But I'm not really asking about what the consequences are. More like, is it considered the definition? Like, does it meet the definition?
Well, yes, most people think it does. And the point of the penalty is that the $20 million, when billions, if not trillions of dollars at stake, is nothing. It's a cost of doing business.
Right. So actually, the dollar figure for what the consequence should be actually doesn't really matter. It could be $1. What matters is the jail time.
Right. So, of course, Wall Street has a history of not going to jail. There is one guy from the 2008 financial crisis. He's the only person that actually pled guilty, I think because of a guilty conscience. And if you looked into him,
This is Raj
he's a
Ratnam.
pretty decent guy. What's that?
It's Raj Ratnam.
No, his name was God, I'm gonna misremember, like Kareem Sarageldam, something like that. If that's not his name, it's similar. I apologize for mispronouncing it and not remembering, but he worked for Credit Suisse. He was a pretty young guy. He lived a pretty simple life. You know, he had like a modest home, not much furniture. He just seemed like a decent guy.
Getting back to the Reddit thing.
Yeah.
If people understand
Mm-hmm.
that the subreddit has been invaded and that is no longer serving its function that previously people went there for,
right,
then why don't they just create a new one?
They have. So there's several. There's like Wall Street Bets New, Wall Street Bets 2, Wall Street Bets OG, Wall Street Bets OG, Elite and OG, and slash GameStop, or GME rather. So yeah, there are numerous new subreddits that have popped up.
And then you can also ban the people that are posting those things, right?
Right, exactly. So that's like a...
Well, they should do that, right?
Yeah, I mean, it's a very robust community now. Several 100,000 members, but the shills seem to be infiltrating it now too.
Okay, so back to the thing about the shorting being a Ponzi scheme. What I would say is that buying, you can only purchase X percentage or whatever of a company, right? Because there's only a certain amount of shares out there. You can't have more people that own the shares than there are existing shares. So because of the way that shorting works, you can continuously short the same share like billions of or infinite amount of times. You can have greater amounts of short versus the amount of shares that actually exist. So that, I think, is actually the root of the problem.
It is the root. Well, it is one of the many problems. So with shorting, you have to have shares to borrow. So if everybody makes their shares unavailable for borrowing, then they can't short. People do, though, because you can make money that way by lending out your shares. It's a very small amount of money. But the net effect, I think, in the short term is very bad because it pushes the price down. So on paper, it looks like you're losing money. When the things rebound, if they ever do, in the case of a short squeeze, for example, then you would make a disproportionate amount of money because things tend to behave irrationally, right? When they shoot up, they usually shoot up too high. When they fall down, they tend to fall down too low. So there's that to consider. For a long-term investor, it doesn't matter because things even out over time. But let's get into the numbers a little bit, because just looking at the behavior is not enough to prove fraud, right? GameStop has only ever issued 69.75 million shares. Let's just call it 70 million shares. Well, institutions apparently own 120 to 140% of the 70 million shares. So they already own more shares than should exist.
Wait, that doesn't make any sense though.
Shorting all the synthetic shares. Does that make sense? Mike?
I'm just trying to think.
Okay. Remember, A, B, and C. You're shareholder A. Let's say you own all the shares of GameStop, all 70 million, but you make them available for borrowing, and I borrow them and I short sell them. Well, now the 70 million is 140 million, assuming that I borrowed all of them and sold all of them, right? So now there's 200%. So you can own 100%. If I've sold them all to John, John can also own 100%. So now there's 200%.
Wait. So here's the. Okay, maybe we'll need John to answer this one.
Yeah.
If you have a situation where, let's say, John is the other purchaser of the other 100%, right? So I own 100% of the shares, right? Essentially, I'm almost a private company.
Right.
So I own 100% of the shares, and you shorted 100% of the shares for John.
Yeah.
Who has the voting power?
That is a very good question. If you both choose to exercise it, you have equal voting power.
That doesn't make any sense because I actually own the whole company.
Right. But you
John
also
should
let me
have-
short it.
John should have 0 shares.
Right.
Not to vote on.
Right. But you decided to let me borrow it to short. So John owns just as many shares as you do. So he has just
Right.
as much voting power as you do.
Doesn't that mean that John should have 100% of the voting power and not me?
But you're both vying for 100, and the total is 200. So you actually have 50-50.
I mean, I'm not sure. So to just be clear on, well, my views, I've been trying to not bias anything. I think everything, most of the stuff Conway said is right, and we've talked about it a bunch. As for this point, I feel like whoever borrowed it last should be the one that is holding it and would have voting rights. If you lent it out, if I lent, like, let's just say it was a physical thing, right? Like I had a little physical certificate, and I give it to Conway to borrow out, and then Mike buys it from you. I don't have the certificate anymore, so I can't actually say, "Hey, I have 1 share," or whatever it is, to vote as. So if Mike was the last person that bought it, then I figure he would have it.
Right. So actually, in that case, in our situation we just said, I would not have any voting power. It would belong to you as John, because John has the last person that bought all the shares.
So what you can do as the business owner is you can recall your shares. And that way you regain your voting power.
So it should ever only be 100%.
There should only be 100%. Yeah. So, okay. So institutions own somewhere between 120 and 140% of all shares. Insiders, the board of GameStop, they own, I forget exactly the number, but let's call it 30. It's about 30. So now we're looking at 150 to 170% shares. Now, there's also retail, and we don't really know how much retail owns. But Reddit is fairly confident that retail owns over 100% of the remaining float, which might be another 30%. So we're looking at possibly 200% shares in existence. But then we have to look at the failure to deliver numbers as well. So I don't know where people are getting these numbers from. I'm just going to be repeating information that I've seen on Reddit. It's possible that 300 to 1,000% of the shares now exist. Meaning for every 1 legitimate share of GameStop that has been issued by the company, there could be up to 10 copies of it floating around there somewhere. So it's a very bad situation.
Shouldn't that mean that it's actually one share that's been passed 10 times? That's been shorted 10 times?
Right, but what about all the people that bought the shorted stock? Do they just lose their entire investment? No,
Well,
that's not the way it works, right? They still have to be paid back.
They have they have a contract, right? Okay.
Correct. Yeah.
So if you say that each share has been passed 10 times, that would mean that short interest should be through the roof.
It is. Officially reported by FINRA, it is very low.
How could they be that far off?
So there's some theories about that. A lot of people on Wall Street apparently don't have any respect for the SEC or for FINRA. They consider them complicit. They consider them bought and sold. Like willing to take bribes or willing to look the other way, just not doing their job in one way or another. The other thing is that a lot of this information is self-reported, apparently, and they don't check. And the other thing is that there are reporting periods and publishing periods. So if you can get that number down before the reporting period ends, you can legitimately report a lower number. And then you just turn around and go right back to shorting it so that, you don't get margin called.
Yeah, so that's interesting. So now we're getting to legal stuff.
Right.
About the regulations, but they shouldn't be allowing someone to just report a number on a certain day.
Right.
They should require a number on a certain day plus the average since the last reporting period.
Yeah. Or we can move to instant settlement and more granular reporting, preferably daily. If we can ever get to the point where it's live updates, that would be ideal to the retail investor, but then a lot of these shenanigans would probably be impossible to pull on Wall Street. So then you would
We should
have to go to value investing.
Well, actually, what it means is that the market is more efficient.
Right. Not to a greedy person, though. They want to take care of inefficiencies, or rather, they'd rather take advantage of inefficiencies to make as much money as possible. Right.
Right, but the purpose of the market.
No, the purpose of the market is to make money.
The purpose of the market is to direct funds to profitable companies so that it can advance the society.
That is the ideal purpose of it. But we do not live in an ideal world. We live in a very greedy and selfish world.
I understand that, but we either allow
I agree with you. Personally, I think that a blockchain is potentially a solution. Something like the Ethereum network, where, information is, verified in a distributed manner, sharded, so that the market can still be fast, efficient, but also incorruptible or very difficult to corrupt. Something like that, I think, would be ideal. We would have instant settlements. We could write code and plug it into the network to get live information. Whether or not we have enough computing power, I don't know. I think we could get there. But I don't think a lot of people on Wall Street want that. First of all, I think that technology like that would probably make a lot of people redundant and unnecessary. So they would lose their jobs. But I do think that that's the future.
Yeah, so I guess getting the perfect system is just too difficult to make a reality anytime in the next 100 years, probably. Just throwing the number out there.
There's a lot of very wealthy people fighting against it. So it's difficult.
But, what I would say to those people that say, like, well, I make a living taking advantage of the inefficiencies. what I would say is we're not removing all the inefficiencies. There's always going to be inefficiency.
Yeah.
It's just whether or not you think you're good enough to find the inefficiency next.
Yeah.
And actually, I don't care if they aren't good enough.
Yeah, I don't care either. I'm just saying that these people are significantly wealthier than you or I, have a lot more connections, relationships, power, influence, and
Yeah,
it's going to be difficult to change this.
That's always going to be I guess so. It's always the problem.
Yeah.
And I guess enough of the monetary consequences to these sorts of actions, because we have numbers around what we expect human life to be worth, right?
Right.
Actuaries come up with those numbers, and
Yeah.
and we factor that into our I'm sure the military has numbers on that, right? Because they're the ones that decide on whether or not we should buy a $500,000 bulletproof vest for the soldier. Right?
Yeah.
So obviously the government has some sort of number like that. So it's probably on the order of millions.
Yeah.
But if someone commits a financial crime, right,
Yeah.
that is a $20 million fine, we should be looking at life in prison now.
Yeah, we should be. A lot of people are focusing on Robinhood because they were supposed to be the people's app. They, created this app that had a lot of gamification techniques, a lot of operant conditioning techniques, right? I don't know if you've ever used Robinhood, but when you sign up for it and you open up the app, confetti flies across the screen and you get a scratch off lotto ticket. And that's like gambling addiction. When you make a trade, first of all, they simplify things and give you very little information. So you don't understand the risks that you're taking when you're buying a call or a put option. And when you make a trade, confetti flies across the screen again, and it's like it rewards you for trading. And
so I read about Robinhood, and I think the democratization of trading is a good thing, but you got to be doing it responsibly. So whether or not they've done it responsibly is like a whole other conversation.
So
I don't know that people should be. I mean, I guess a lot of people are using Robinhood as like a pinata right now to beat.
Yes. So yes, Robinhood is most likely getting thrown under the bus and blamed for all this, but the bigger players at stake are bigger criminals, in my opinion.
Right. I don't know that they deserve the. I don't know that they deserve to be the pinata. Maybe they do a little bit, but definitely not 100%.
So there's two things about their business model that I have a problem with. The first is that they use payment for order flow. If you're not familiar with what that is they collect all of the buy and sell data and they pass it along to their partners, which is a high frequency trading algorithm. So they can front run your trades and give you a worse price. It's theoretically possible. They deny it. I think it's impossible that they don't do at least a little bit of this. I'm pretty sure that they do this all the time. But again,
wait. So payment for order flow doesn't immediately mean that they are doing it to the detriment of the buyer.
Correct. It doesn't mean that they are. It means that the possibility is there.
Right. So the other thing about, payment for order flow was invented by freaking Madoff, right?
Bernie Madoff. Right.
Right. So ideally, what it's supposed to do is create better markets to be able to allow trades to execute quicker. Maybe.
I don't think so, because you're passing that information along rather than just directly executing on it.
But Robinhood isn't the market maker, right? They do not actually physically have the shares to sell. So they pass the information along to someone that can.
That's right.
I guess actually execute the trades at the market maker.
So there's another thing. I forget the acronym for it and I forget what it stands for at the moment. But basically, what happens is that there's a chance that when you make a trade on Robinhood or Webull or any of these mobile apps and lower quality, quote unquote, brokers, they don't actually execute your trade, but they do collect the data. So then basically they pretend to buy your share that you wanted to buy. But because they don't actually execute on it, it doesn't push the market up. And then at the end of the day, they can pay you back or at whatever time period. The point is that there's no real buying pressure, so then the price doesn't actually get pushed up. Those trades never actually go through to the real market. And because they have the information now, if they wanted to, they could take the other side of the trade, push the prices down, and make sure that you lose money.
So the problem then becomes at the point at which I ask to purchase or sell one share or multiple shares, and someone told me that it was successfully executed.
Yeah.
It means I either have that share or I no longer have that share, right?
Right. And
You can't trick me. You can't trick me into saying that, well, I'm just going to buy it later or sell it later.
Yeah.
Here's the money now.
Right.
That sounds like it should not be legal.
It shouldn't be legal. But again,
and the reason it shouldn't be legal is because it goes back to the voting power, right?
Yeah. I mean, it doesn't have to go back to voting power, but that's certainly an aspect of this. It's really complicated, obviously. But these are things that people are discovering now.
Yeah, so the thing about the payment for order flow thing, in case maybe you know this or maybe you don't know this or maybe John can shed some light. The people that are market makers that want to buy the information or buy the payment for order flow is that these market makers can make money based on who is buying and selling.
Yep.
Their entire purpose for the market makers, right? What they make is the bid and ask, right? The difference between the bid and ask.
Right.
So market makers generally want to buy and sell to people that know nothing. They don't want to buy and sell to somebody that has perfect information, right? Because then they will always lose. They'll always be on the losing end of the trade.
Yeah.
And because of the fact that Robinhood in general has a lot of retail investors, which people would say do not have the resources to be able to get the information that, like, say, a hedge fund or institutional would have, right? That's why they get paid the most for their order flow, because a market maker is a lot more likely to be able to make money when executing the trade at Robinhood versus, I don't know, like a hedge fund or something.
Yeah. So there's been studies about this as well. When Robinhood is active, the bid-ask spread is pretty wide, which means that market makers can make more money on the bid and ask. When Robinhood crashes and it goes down, so that bid and ask spread becomes very tight. And the only difference appears to be Robinhood. So now the question is it causal? It seems to be, but obviously you need more information than just that to determine that.
Yeah, so this is ripe for abuse.
Oh yeah, absolutely. It was designed for abuse.
What I would do if I was an institutional or a hedge fund is I would make 1 billion accounts on Robinhood, trade using an API, and do it all myself, like I would previously.
Yeah. So part of the problem with payment for order flow is apparently everybody uses it. Even the good brokers that you wouldn't expect them to use it, they use it. Fidelity, their options market gets routed through a payment for order flow system. Vanguard as well. So it's everywhere, unfortunately. As far as Robinhood goes,
it's because they don't want to do that themselves. I mean, they're paying to not do it themselves.
Yeah.
Well, actually, they get paid to be able to route to a person that says, "I will do it all for you."
Yeah.
Yeah, it's extra money for them.
It is. Yeah. So the 3 players that were scrutinized by Congress in all this mess was Robinhood, Melvin Capital, and Citadel. Citadel is a market maker. They're an interesting one. They apparently handle 99% of retail options trading because they're the clearinghouse for Robinhood. Melvin is a hedge fund that went Superman short on GameStop. Why would you ever go that far short on a company? Well, you either think that they're fraudulent and so that they deserve to be shorted, or there's something else at play. Now, there's something that I learned that I haven't verified yet. I tried talking to Sandeep about this because he works at a hedge fund. I don't want to mention which hedge fund, but it's a hedge fund that has been implicated in this mess as well. What I had read on Reddit, which I have not verified, is that there's a tax loophole when you short a company. So, picture this. A few years ago, GameStop is a dying brick and mortar retailer. Things are moving towards online and direct downloads. Amazon's killing everybody. You don't need a store like GameStop anymore. Makes sense. Pandemic hits. Commercial real estate gets hit really hard. GameStop stock goes from $40, $50 in 2014 down to $2.57 in March of last year. Looks really bad. Looks really, really bad. Here's the tax loophole. What I read is that when you short a company, you open this short position. If the company goes out of business and the stock goes to zero, the company disappears, your position never has to close. You never have to close your position. So technically, you made all that money tax-free. Normally, when you take a position, right, you open a position, you close a position. Once you've closed the position, your profits are called realized. If it's just an open position, they're unrealized gains or losses. But when you close it, those losses or gains become realized. And it's when you realize those gains or losses that there are tax implications. So
Right.
that is the loophole, is that if the company went out of business, you would never have to close your position and your profits would never be realized technically and never have to pay taxes on them. And when you short, you get the money right away so that if you wanted to go long on something, you could long something else.
Do you have to close your position when the company is delisted?
That I don't know. What I read was that you don't. It just, the company gets delisted. Some things happen on the broker side. I don't exactly know. And you just made all that money for free. And all these hedge funds. Say again?
There's a freaking chasm.
Yeah.
It doesn't make any sense.
I know.
Because
all these hedge funds are like,
I think it'd be closed if the company went bankrupt. Just like if a company got bought out, they would just settle it.
But then the question becomes, why wouldn't you close your position when the stock is $2.57? Why did you open more at $4? And then why didn't you buy to cover when the stock started going up? Because it was a long period of time between March of last year and November, December, early January, where the highest it got to was $20 a share. And it was only by the end of January that it started skyrocketing. The highest I saw was $515 pre-market on a wick. Right? So
They could say it's gone to zero though, right?
I mean, I don't think there was any hope of it going to zero. Michael Burry invested in it.
I'm just saying someone could take a position. They could be anyone who thinks anything.
Yeah, that's true.
I can actually sympathize with having some sort of regulation to say that you don't necessarily have to close your position immediately. or rather, you don't have to pay taxes on it immediately. And the reason for that is because when you shorted that stock or you bought that stock, and you may legitimately expect to close the position in over a year and have to pay a capital gains tax instead of whatever corporate tax, or if you're an individual, you pay based on your income, right? So based on income based. So if you pay the capital gains rate, then obviously it's going to be much lower, which is perfect. I understand it. So if a company goes bankrupt and you've shorted it, then you should have to pay the capital gain or whatever the lower rate is, not the corporate rate or whatever. Like, that sort of makes sense to me. What doesn't make sense to me is that you never have to cover your position.
Yeah. Like I said, I don't know the facts about the tax implications. When I asked Sandeep about it, he said it's absolutely not true. Most of Reddit seems to think that it's true. And I haven't researched it enough to know if any of them are, accountants, CPAs, tax professionals. I don't know.
So Sandeep is saying it's not true, then I'm not saying that Sandeep is, freaking tax expert or something, but it seems like it would be tough to believe.
Yeah. Yeah. The other thing about shorting is that obviously the way that they're shorting drives the price down so much that people lose confidence. And if you don't know what's happening, whether or not you are a normal person or an investor or maybe even on the board of the company, you may not understand why your stock price is going down. And then maybe you get tilted and you start making bad decisions, which GameStop did. Radio Shack famously did too. Toys R Us as well. These are all companies that were heavily shorted and basically shorted out of existence. It erodes consumer confidence. When your stock is very low, it becomes hard to raise capital as well. And so then if you can't raise capital, you can't really expand. You can't really have too much freedom in changing the business. It's very difficult to innovate. And so I find it malicious, shorting.
I agree in terms of philosophically.
Yeah.
I agree philosophically that shorting doesn't really help a market function, like an economy function, as much as long.
Yeah, it depends, right? Like, if the company is legitimately fraudulent, it should get shorted, and it should get shorted into the ground. The problem is that it seems like more often than not, shorting is used irresponsibly, maliciously sometimes. But also they work with short seller reporters and they create questionable, if not outright fraudulent, short interest reports, or rather alleging fraud when there's no fraud. And a lot of companies suffer because of this.
So about the question about whether or not, about how shorting erodes confidence.
Yeah.
That's kind of delicate because it can be looked at the other way too, because.
Yeah, no, absolutely. When people long things too much.
Right.
And from a fundamental perspective, a company becomes overvalued. People can be driven to mania. And if they FOMO into it, they put themselves at a lot of risk. Somebody who buys Tesla at $37 a share is at a lot less risk than someone who bought Tesla at $900 a share, considering that it's fallen down to somewhere between $600 and $700 today. The $37 per share person, they made a lot of money. Now, does it suck to see it go from 900 down to 600, 700? Yeah, it sucks, but you're still positive, Now, the person who bought it at 900 and now has to deal with 600, well, you lost a third of your money. That feels bad. That feels really bad.
Well, because I love finding holes in the system.
Yeah.
I'm going to propose something and ask you if these things are possible. And maybe we don't know. It's very possible we don't know. John, I want you to listen to something. So as Conway was saying, you generate kind of synthetic shares when you buy and sell. And then it ends up being, well, do you have voting power when you have like these synthetic shares? Doesn't there exist a possibility that I short my own share and then sell it back to myself?
Yeah, I guess so.
So what if I do that 1 trillion times for a company? And then I oust the board because I own more shares.
I think that's happened before.
Why would you do it? Because you don't lose money to yourself when you do that, right?
Yeah. No, I do think that's happened before. And potentially that has happened at GameStop. So they recently replaced their CFO. I don't know too much about why, but it seems, in retrospect, that this CFO was pretty ineffective. The question is, why was he ineffective? Why was he even there in the first place? I don't know. So that's somewhat relevant to what you were talking about. There's a chance that he was working with Wall Street and he knew what was going on and he just refused to take action. It's possible. How likely is it? I don't know. It could be low. It could be high. No idea.
I think that's too much of an unknown. It could be for anything. The guy could have just quit because it's too crazy.
Yeah. But similar stories have happened before. There was this is unrelated to GameStop, but it's related to tactics that short sellers use. There was a taser company. I forget the exact name. But this company was very heavily shorted. A lot of negative press came out about it. And they saw their share value swing wildly. They went from low double-digit price as a startup, essentially, to triple-digit prices. Looked like they were doing very well. They were getting a lot of attention from police and, personal self-defense, those areas. It looked like they were going to do well. And then they got shorted. And then a lot of inside information got leaked out. A lot of false information was passed around. And I think the FBI got involved and they had to investigate. Turns out the CEO's personal secretary was a mole planted by Wall Street, by short sellers. When she was confronted about it, she pulled a pre-written letter of resignation out of her purse, handed it over, walked away. Nobody ever saw her again.
So she's at the bottom of a river?
No. I think she probably got paid a lot of money. And she's probably sipping Mai Tais in some tropical beach location now. Who knows?
Well, to get to Mike's theoretical, so I still kind of think it's like 1 stock certificate per vote, let's say, whatever it would be. But
Right.
Even if it wasn't that, right, you still have to buy it first. So you're putting up extra money, and then even if you made 2 accounts and you're borrowing it from the other person, you're paying the other person money.
Yeah, it's very inefficient.
And so you'd have a lot of extra fees. So I'm not sure that it would make a lot of sense. You'd have to basically be able to buy, let's say, more than half the company. So then you could just do a direct thing to the company and be like, I'm just going to buy up your shares or whatever.
But because you're shorting it, you're giving yourself back the money, and then you give it to your.
Okay, so when you short something, you have to pay borrow fees, so that eats into your money.
Yeah, but the borrow fees can't be as much as the share cost, right?
It depends. It fluctuates.
But also,
yeah,
I don't think you can really do it on the side, right? You can't just say, I'm going to sell it to this person. It's really through the open market with market makers and stuff. So it's kind of anonymous, whoever the other party would be.
So essentially, you have to be a market maker yourself to do it.
Yeah. So there's a lot of things I want to touch on.
Yeah.
It is anonymous. when you take a long position as a financial institution, you have to disclose your position if you're on the long side. When you're on the short side, you don't have to do that. Now, there are markers, there are tells, right? So if you have a lot of puts, it's a pretty clear indicator that you're shorting it. But the fact that nobody knows how far short you are, that's a lack of transparency that has real world implications.
Just because you have put doesn't mean you're short. You could be hedging the position.
You could be. Yeah, you could be. But you would see your long positions then. Right?
Oh,
So you
okay,
would
I see what
see
you're saying.
you have this many shares long and you have this many puts as a hedge. And maybe you have calls that you disclose as well, right? So you could kind of figure things out. But if you just have puts and you don't have longs, it's a pretty clear indication that not only are you short the company, but you're trying to use the put options as additional leverage to drive it down. What was the other thing? Going back to something I said earlier. At the end of January, if you check the failure to deliver report, there were like millions of shares of GameStop that were failed to deliver. If you plotted all of the failure to delivers in the entire market on a graph, you wouldn't even see the other ones compared to how much GameStop had. It was that bad.
Can you explain failure to deliver?
Sure. A failure to deliver is if you bought a share and I need to give you a share, I need to deliver you a share, and I don't, I give you an IOU saying that, hey, you bought the share and I owe you this share. I can't locate one right now, but I got a couple days before I get in any trouble for this. Now I have to locate that share for you. As a market maker, you can have up to 21 days or something like that before that has to be resolved. The problem is that what happens if this failure to deliver goes from accidental, incidental, to intentional? What if you're using failure to delivers on purpose, strategically? That seems to be what happened with GameStop. And because of the settlement issue, because of the huge short interest issue, because of all the shareholders buying and holding and not selling, and a lot of them turning off the option to lend shares out for additional borrowing and therefore additional shorting. I mean, that's the Ponzi scheme, right?
So,
I'm constantly creating more failures to deliver, juggling that within the time window that I have, and delivering synthetic shares to pay back synthetic shares because I shorted so much that it's a huge mess.
you're saying that you're given an IOU. Do you never get the share? Does it never execute?
They just, when it's due, they short something else. They give you that, and they reset the timer. No legitimate shares, or very few, I should say, actually get delivered. Because remember, there are so many synthetic shares that it's impossible to tell what's what at this point.
So, because somebody still needs to short the share to pay it back to you,
Yeah.
doesn't that negate you have one buy and one sell action and should not change the price at all?
It depends on the bid and ask, right? But the point is that the supply is so huge now. And more people are buying and not holding, which is why we've seen the price go up. But if they weren't doing that, we probably would be seeing the price go down.
I want to get back to the thing about whether or not people are maliciously abusing the failure to deliver thing.
Okay. Yeah, again, there's no smoking gun. There's a tremendous amount of evidence that doesn't prove their intention. But GameStop failure to deliver is in mid-January to the end of January. Mid-January is enormous. I forget the exact number, but it was multiple millions. I can look it up, but
Yeah.
for
So
the sake of conversation, we'll just go with it. By the end of January, it went down to like 10,000. So the question is, well, what happened? Did they actually make good on all those failure to delivers? Did they actually cover their short position? They say yes. But then why did the price go down? You would think that, well, I mean, this is a short squeeze. In the case of a short squeeze, the price goes up, not down. But the price went down, and the volume didn't seem to indicate that that they had covered. In fact, going back and looking at that data, it seems impossible that they could have covered. The numbers just don't show that they covered. So they're lying, probably. What else happened? Well, an ETF called XRT, their failure to deliver, instead of going down, it went up. And it was like an exact inverse relationship to GameStop. So then you have to look at XRT. Why did XRT FTDs go up? XRT is an ETF of retail. And one of their biggest holdings is GameStop. So what's most likely happening is that these hedge funds are hiding their short position using over 60 different ETFs, where they short the ETF, they buy the underlying companies, like shares in the companies, but they leave out the one that they're short on. That way they have a net long position in all these other companies. They've shorted the ETF proportionately, so they're net neutral, except that they've left out their GameStop position. So the price remains low. They're synthetically shorting now. They can also synthetically cover by buying calls. What's up?
Just to make sure I understand. You were saying that they short the ETFs which hold the game.
Correct.
And then they purchase
Correct.
GameStop?
Remember, when you short something, you get the money right away if it goes down, right? When you short something, you're hoping it goes down. And whatever it goes down by, that's your profit minus fees. So then if it does go down and you make money, you can go long on something with that money. You still owe back the shorted share eventually, but they don't expire. You can hold on to it for as long as you want. And so you can take the money that you got from shorting something and you can go and buy something. So in this instance, you would buy the underlying companies that are in that ETF. So let's say there was an ETF of only two companies. One was GameStop, one was GE. And I short the ETF. So GE goes down, GameStop goes down. But then I buy GE shares. So then the price goes back up. And GE's exactly where it was at the start of this. GameStop is still low. That's basically what's going on here. Also, remember that GameStop has a beta of -8. So when the market goes down, you should see GameStop go up. And in fact, what we do see most of the time is that when GameStop goes up, the entire market goes down.
On the beta point, since it's a statistic, I'll just note, like when you guys talked about it before, I forgot to say it's historical too. So like it's not necessarily predictive; it's correlations.
Right, it's correlation. It doesn't mean causation, and it's historical. So it takes, I don't know how much time. Let's say 10 days. Let's say more than that. I don't know.
It's a lagging indicator, right? It's not a.
Is it a lagging indicator? I think it's just a relationship. I wouldn't say that it's a lagging indicator necessarily. It could be.
It's a statistical measure, so
yeah.
I mean, you can read into whatever you want. Some people could say it's leading or lagging, and you can calculate it based on months or days or years. So
the point is that the relationship seems to be clear.
Well, again, I'm actually saying the relationship's not really clear because depending on how you look at it, it can be something different.
I see. Okay. That makes sense. What else is there?
Well, okay, so I think most of that made sense to me and is possible, and I could see funds doing it because I think a lot of them hedge with ETFs, or in this way they're going synthetic short on a company via an ETF. So yeah, sure, it's possible. On the market maker front, I feel like most of them though, like they wouldn't want to be like taking a position in anything. Like the market maker is really making money on volume because they're getting that bid-ask spread. So
Right.
they want to just they want to not care, right? They want to say, okay, Conway wants to buy 100 shares, Mike wants to sell 100 shares, match them up, make the difference. You know, if you say Conway wants to buy 100 shares and no one else wants to sell it, and then they take a position, then they're kind of like doing something outside their wheelhouse. So it's risky, possible, I think, but I don't think that most of them would want to do it for very long, because they could open them up to a lot of whatever potential market risk or something else.
So most market makers, that's the case, right? There was this regulation that had expired, or they got rid of it, where the case was back in the, the early 2000s? Don't quote me on that, I'm not exactly sure, but it allowed hedge funds to become market makers too. So some hedge funds are also market makers.
Yeah,
and that's what Citadel is doing.
Citadel is an example of this. On top of that, they're also an AP, or an authorized purchaser of XRT. What that means is that they can create more shares of XRT at will. So what's most likely going on here is that hedge funds such as Melvin Capital are shorting XRT. Citadel makes more copies of XRT to let Melvin borrow to short.
Yeah, doesn't it freaking dilute everything though?
It's fucking corrupt.
Wait, John, isn't there a regulation that says that if you get extra shares, that you have to let the current shareholders vote on it?
Sorry, repeat?
I'm going to Conway go first.
I think he's in the bathroom.
I'm going to go get water. I've been talking for a while. I'm thirsty. So repeat your question, and I'll be back.
So Conway was saying that one of these hedge funds is an authorized purchaser, and that they can create shares of the ETF. So they were just creating shares for another hedge fund to short. And I thought that when you just create shares for the market, that you have to put it to a shareholder vote first, because obviously it dilutes them.
No, well, so in this case, we're talking about an ETF. So an ETF's a fund, and all it is just a combination of underlying stocks. So it's not like a company, right? Like whatever, GameStop, GE, whatever. And so it's not like they're diluting additional shareholders. They're saying this ETF is a basket of, let's say, 10 companies. Oh, there's not enough shares out of the ETF itself. So I'm just going to buy whatever these 10 companies and issue another share of this ETF for whatever party. So they're just kind of packaging it. You see what I mean?
Right. So in that case, though, in order for the ETF to issue more shares, they have to spend the money to buy the initial underlying security, the underlying stocks.
Yeah. So I would say the authorized providers, from what I remember about it, it's much like the market maker, right? They're just saying there isn't enough shares of this ETF. I'm going to make more based on demand. And end of the day, they're trying to be transactional. And I think in most cases, right, potentially there's malicious stuff going on. That's the edge case. But in general, the authorized providers are trying to just make that difference. They're going to be like, okay, these shares are worth $10 each, so there's 10 of them, and if I combine this basket, it's going to be 10 times 10. That'll be $100. Well, it's 101. Oh, okay. Then I'm going to take away one of these shares and I'm going to sell it, and then I'm going to make $1, or vice versa.
I'm back. Yeah, I heard all that.
Okay.
Well, yeah, what John was saying is that in that case where the ETF is just generating shares, that they would have to go out and purchase on the market the underlying stocks, the underlying companies, to be able to issue that share. So what you were saying in your example then You have one hedge fund that would have to go out in the market and buy those shares to be able to issue the extra shares of the ETF to the other hedge fund.
Right. So now this is actually a battle between whale and whale. A whale obviously is an enormous entity with a lot of capital. The media is trying to spin it as retail causing chaos in the market, Reddit causing chaos in the market. But like, let's be honest here. We may be the loudest and the noisiest, but we don't have the money. Retail never had the money to be able to move markets to this degree. Maybe in the short term, on a small scale. But at the end of the day, there's so much money tied up in this that it's impossible that it's retail, it's impossible that it's Reddit. So what's going on now is that probably the majority of Wall Street is tied up in this because there's probably a lot of naked call options written out there, meaning they don't have the shares to back up those calls if they ever expire in the money, right? So in the worst case scenario, if everybody has calls that are in the money and they execute, whoever sold those call options, they're going to lose a lot of money because they have to go out into the market and buy shares of GameStop. And that's what happened at the end of January. It was a unique situation where I believe every single call option was in the money, which is unheard of. Now, it's unlikely that everybody would have executed on those contracts. They probably would have just flipped them. But regardless of that, whoever sold those call options,
whoever flipped the contract flipped it to somebody that was going to execute it. Somebody was going to execute.
Right, or whoever sold it would buy it back and not have to go out and buy the shares. Right.
Oh, that's true. Yeah, they can purchase the option back and just take the loss on the option contract.
Right. So that was the end of January, and between that and the high number of failure to delivers, that helps explain why they pulled the plug on GameStop, why they made it so that you couldn't buy, you could only sell shares in GameStop, AMC, several other quote-unquote meme stocks.
In terms of Robinhood, though, it looked like Robinhood had to raise a shit ton of capital.
Right. They did.
And I don't think that that's a conspiracy there. I think they legitimately...
The conspiracy is that they most likely didn't have any of the shares that they owed people. That's the conspiracy. When you buy a share on GameStop, you think that they're going out into the market and buying the share, but most likely they're not. They're just keeping a log of it, pretending like you have a share, but you don't. You don't actually.
So this is where like we're kind of looping back around now. It doesn't make sense to me that someone can give you an IOU on something that you don't actually own anymore because you're supposed to have voting rights, right? You're supposed to own a piece of that company, and now someone's telling you that you do own it, but you don't actually own it.
Yeah. So.
Well, I think Tom is actually getting at the time lag of buying and actually having it and owning and being able to vote. Because you don't. It's not like you need to vote every day, right?
You only really vote once or twice a year, maybe 4 times
right,
a year.
Right. But when it matters is that when someone owns exactly 50% of the company.
Yeah.
Because that one share allows him to have control.
Well, the company can recall the shares. And that is what we're getting to this week.
So before we go there, my skeptic's head on it is not most of the stuff that Conway's talked about. Right? I think it's like, it's all possible. Theoretically, it's the statement. This is affecting like the whole market and everyone's involved. That I think is pretty outrageous. Like that's harder to believe, right? That everyone's in on it, everyone's involved somehow, and this one GameStop thing is just affecting everyone.
Well, payment for order flow does affect everybody. And that's a model that in the most recent congressional hearing was heavily scrutinized. And it looks like they're going to regulate it or, I don't know, maybe get rid of it. I doubt it, but it was talked about. For GameStop specifically, look, if you have call or put options or shares, this affects you. So
Just for that company, though, not for like the whole market, though. That's what I mean.
right, so the short interest is so high that when this thing unwinds, we don't know the exact implications of it. So what's happening now? I don't know. What I theorize is that short sellers, they're desperate to kick this can down the road. And so they could be shorting any number of things, including the bond market. That is a whole other can of worms that we'll have to get into some other time or later today. But long story short, it just doesn't make sense to me that the yield should be rising right now, that people should be worried about inflation when the data doesn't show that we have inflation. A lot of people are going to think that that's a crazy statement because when you go out to the grocery store, everything's more expensive. Gas is more expensive. Like everything just seems to be getting more expensive. This is inflation, right? But what's a marker for inflation? Well, you could go to investing.com and look at the economic calendar and see that we have deflation. You could also look at gold, which is traditionally a hedge against inflation. Gold's been declining since August. If we actually had inflation, shouldn't these things be going up, not down? I think so.
I think those are all correlations. That there's no law that says it has to go one way or another.
Yes, you're right, John. I'm just saying that a lot of things don't make sense. So here's the conspiracy theory part 2. It's possible that, look, Janet Yellen has said that there will never be another market crash as long as she lives. She's also new to the Treasury.
She was Fed chair.
Right. She was a Fed chair. So it's very concerning that she's now head of the Treasury. But she doesn't want to look bad. Jerome Powell doesn't want to look bad. So maybe the conspiracy part of it is that, look, we'll let you keep shorting the bond market. By the way, there's a 4 standard deviation net short position on long bonds, TLT, with the 30-year. Never happened before in history. And again, when you short something, you get the money right away. So if you can keep shorting it, you can keep getting money to do whatever you want. And in this situation, they're getting the money.
But it's based on margin, right? You have to have some sort of capital.
Yeah, you do.
Because I can't just go out and short 1 million shares of something. They're not going to make it.
So Melvin had $3 billion injected to them at the end of January, which they lost almost instantly.
Yeah, but
I don't know what
$3
else.
$3 billion is nothing compared to the money that moves in the bond market.
Yeah, you're right. Melvin recently issued bonds, triple B negative, so dog shit bonds for $600 million.
Let's not use that. It's still investment grade.
Okay, speculative investment grade. But they're still triple B negative rated. They're not triple A. They're not double A. They're not even anywhere close to that. $600 million. Some people were saying 60 billion, but I think it's 600 million. Regardless, it's still a decent amount of money, a lot of money. Why do they need that money when they're telling everybody that everything's fine and that they're doing very well? I don't know. It's a little suspicious. It's very suspicious to me. But to the casual observer, it should at least be a little bit suspicious when they say that everything's fine, they're doing great. By the way, here's some bonds. We would like to get $600 million.
Well, companies sell bonds all the time, right?
Yeah, but
when they've done this last, if they've never ever done this, then maybe it's suspicious.
Still, I mean, if you're financially fine and you don't have any expenditures in the near future, Would you need to raise capital? Do you just raise capital for no reason? Probably not, right?
What do
Probably
you mean?
raise it for
It's
a reason.
leverage. They do that all the time.
Yeah, maybe. I guess so.
Right? Like just because I could buy a car doesn't mean I buy the car. I could say I'm going to borrow money to buy the car, and I could use that money for something else. In their case, they're a fund. They may be able to leverage even more. Maybe that's bad, right? But they may want to do that. Lots of hedge funds do that. I don't, like Mike said, I don't know if they've done it in the past, but it doesn't really sound that crazy unless it was exactly the same amount that they need to cover their GameStop position or something.
And again, because of the opacity of the market and because of the lack of transparency, we don't know.
Yeah, it's possible that they
Sure,
just
there are
don't have.
markers, and you could probably reverse engineer it, but it would take some work. And I'm just not smart enough or diligent enough to be able to do that.
It's also possible that they just didn't have the free capital.
Yeah.
As in the cash, free cash, because the cash could have been tied up, and they can say, well, we are plus, I don't know, $1 billion, whatever, in all of our positions. We look at it, but we don't actually want to sell these positions to have the free cash to do something else with it.
Right. So then
it's possible that everything is fine. I mean, maybe. We just don't know.
So then there's some other things that have been suspicious that have happened. Immediately after the end of January, even during it, a lot of news stories started coming out saying, forget GameStop, forget AMC. This is what Reddit has turned their sights on next. Reddit is trying to short squeeze the silver market. Everyone should buy SLV. And you go and look at SLV. This part probably means less than what I'm attributing it to. But again, I'm in this very conspiratorial mindset. So you have to consider that. Citadel was one of the largest shareholders of SLV. So wouldn't they want to pump that up? If this was a pump and dump, wouldn't they want everybody to pile into SLV, drive the prices up so that they can sell? Give me a second. I have to